Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. The Wells Fargo Investment Institute issued its 2021 Outlook report, Forging a Path Forward. Joining me is Scott Wren, senior global market strategist at Wells Fargo Investment Institute. Scott, it's great to see you as always. Welcome back to Trade Talks.
Thanks, Jill.
Let's review some of the findings. How do you expect the global economy to perform in 2021, and what's the risk to that outlook?
Well, certainly the global economy is going to perform better. I don't care what major region you're talking about, better in 2021 than it did in 2020. So I think that, whether it's Europe, the US, China, and much of the emerging world, it's going to be better GDP. It's not going to be contraction. It's going to be growth. World growth should be in excess of 5%. And I would argue, the risk to the growth is the same that really it's been for most of 2020, and that's vaccines, distribution, what's the virus going to do? So the markets clearly in really around the world have been counting on good news in terms of the vaccine. That's clearly been the case. And I think now it's a distribution logistics issue. And if we can get the vaccine to the masses, things will be good.
With valuations at record levels, what's your outlook for global equities?
Well, I think in terms of global equities, you cannot look at what's happened the last 12 months in terms of earnings, because that was a big hit to earnings, 20%. But by the time it's all over and done with, we'll probably be down 20% versus 2019. I think you need to look ahead. And so our number for the S&P 500, for instance, is $175 this year. Our target's, a bit higher than where we are now. We're looking for probably a, 6 to 8% total return, something like that. That had put the price to earnings ratio, if you're looking at that measure, let's call it 22 times. Now, that's certainly higher than what the longer term average has been, well below that 32 times we saw in March of 2000 before the tech bubble burst. And I think you have to think about what's the Federal Reserve going to do. Interest rates are going to stay low. Inflation's going to stay low. There's a lot of pent-up demand, whether it's for economic activity in terms of consumer spending or just for stocks, because there's a lot of cash on the sidelines. So I think if you're really glued to what the long-term valuation is in the market, you're going to miss what's going to happen here in 2021, because we're trying to think about what's the central banks around the world doing. They want to be very easy. It's going to be for a long period of time. And so I think in this inflation environment, even though we'll see a little higher inflation, you're going to see those valuations stay elevated. So don't let that scare you away from these stock markets.
And speaking of interest rates, where are the opportunities in fixed income?
Well, I think as we look at it, clearly in a better economy with a little higher inflation, rates are probably going to be a little bit better. And so we see the 10-year trading up maybe towards 1.5% here by the end of the year. So a move, but a rather modest move if we look at history as far as the absolute level. We like high yield. If you think the economy is going to recover, not just here in the US, but abroad, you need to look at some of these higher risk sectors. High yield, we do like corporate credit. We could move a little bit down on the, or a little bit up on the risk scale there. In other words, taking on a little bit more risk. That'd kind of jive with our high yield outlook. We continue to like munis. There's probably going to be some help for these munis as we see that the Democrats have swept and own the presidency and both houses of Congress. So I think munis are going to do well. High yield's the one that I think, even though we've seen those spreads narrow, still likely to be some good returns there.
And Scott, to wrap up here, what are the top 5 portfolio ideas for 2021?
Well, Jill, as I look at my list, I think the first thing, and if you think of a retail investor, they need to have a plan, because we're going to see opportunities. We're going to see volatility. And if you don't have a plan, volatility is going to come and go and you won't be able to participate. So I would say the first thing is you got to have a plan. You got to be ready to step in, know what you want to buy. You have to lean toward recovery, whether it's tech, communication services, materials. We're starting to get interested in industrials. You want to lean towards those sectors and asset classes like high yield that are sensitive to a continuation of this recovery. We still like U.S. large caps now. Small caps are becoming more interesting. We like the U.S. over international right now. We're keeping a close eye on that. And then commodities would be another one that, we've seen a good run in the price of copper. We think there's more upside there. And commodities are going to respond to a bit lower dollar, not a dramatically lower dollar, but a bit lower dollar, and then better global growth. So those are some of the ideas that really we've been working with our clients and trying to put into their portfolios.
All right, Scott, great to catch up with you as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.